Hey guys, Patrick here. Just wanted to shoot this quick video regarding a meeting I just got through with a client. And this is something that a lot of financial advisors do when they're meeting with clients, especially for the first time, is trying to identify what their risk tolerance is in their investment portfolio. And the way that a lot of advisors approach it is they have clients fill out what's called a risk tolerance questionnaire, or RTQ, to be short with it. And I just wanted to give a quick thought here. So if you are a client of a financial advisor and you're thinking about how you're invested, and it's relevant right now because the markets are obviously very shaky, there's a lot of uncertainty, and just understand that for the most part, if you're newly working with a financial advisor, your portfolio might be allocated based off of a document that you filled out with your advisor, and that's exactly what he or she is supposed to be doing, in my opinion, right? They need to have some way of gauging how you emotionally feel about market risk. Now, just understand that there's many types of risk, right? There's market fluctuation risk, there's what's called idiosyncratic risk, that's just tied to one specific company. There's interest rate risk, there's credit risk, there's geopolitical risk. There's so many different types of risks, right? But the one that we all focus on as investors, for the most part, is that market risk, right? That beta risk. How much am I going to fluctuate up or down if the market changes? And that's what the risk tolerance is really kind of tied to, is if, for example, the market went down, and this is probably a question you've seen, the market goes down or my portfolio goes down 20%, what would I do? Would I sell everything? Would I hold on to it but not be happy? Or would I consider this a buying opportunity, right? Or some variation of that. Now, I just wanted to point this out here, that there's a difference between what people say and what people actually do. And as I've grown in my career, as I've learned going through different market cycles, what you need to understand as an investor, and this also applies to other advisors who have clients, is just because a client answers a question on a risk tolerance questionnaire that they would, hold on to their investments, or they'd buy more, or even if they would sell, that doesn't necessarily mean that's what they're going to do. And that's probably one of my bigger issues with the risk tolerance questionnaire is, it's one thing what you say, but show me what you actually do in that situation. Now, as a client, you may really know yourself, and you really may reflect back on those prior experiences, and you might be answering that question accurately. But if you've never been in that situation before, meaning a significant market drop, you may think, yeah, I'd buy more into my portfolio, but until the rubber hits the road, you don't really know what you're going to do in that situation. And sometimes as humans, right, we have short memories. So if we think back to the last market correction, our memory of what we did, how we reacted, how we felt is probably a little bit different, or a lot bit different than what we actually felt, did, or experienced going through that period of time. So I don't want to be too long-winded here, but as a client, just understand when you're filling out this risk tolerance questionnaire, forget about the answers, right? I want you to think back to, if you've been through that experience before, what did you actually do, right? And now a lot of people want to say, yeah, it sounds like the right answer, I guess, to buy more, right? It's like, the old adage, everyone knows, there's a trade of thought out there that if the market goes down, it's a good time to buy. That's not always the case. But I feel like clients want to answer that way, and I think sometimes advisors want clients to answer that way. But the goal at the end of the day is you want to find a portfolio that you can actually stick with. And it's okay if you're freaked out that the market, that if your portfolio were to go down 20%, you may feel like you want to sell those investments, right? Because what that will help the advisor with is put together hopefully a more customized, tailored portfolio to how you actually would react during a downturn. And one of my favorite sayings is this: rising tide lifts all boats, but when the tide goes out, you see who's swimming naked, right? And I believe Warren Buffett said that. And that's an important quote to remember as an investor is when markets are doing good, what you'll probably notice is you're not going to be as focused on your portfolio. You're not going to be as nitpicky. If you're making money, then you're going to be happy for the most part. But when the tide goes out and you see who's swimming naked and you start looking at your own accounts, that's where the rubber hits the road again. So if you like this video, guys, feel free to provide your feedback, maybe throw a comment below. And, if you want to hear more content like this, let me know what your ideas are for future videos I could make. And thank you for your time. Hope to see you in the next video. My name is Patrick Hammond again. See you soon.